Welcome back to the Brent Bruce Daily. Today is August the 11th. It's 2:38 p.m. Central Time. And, make sure that you take a moment to subscribe, like, and share to the YouTube channel. We've got a lot going on. I want to make sure that you don't miss anything. So, you know, people really like to watch the stock market, the excitement of the ups and the downs, the buy, sell, the cheering, the New York Stock Exchange, the movies that we've seen about it. And you know what? In the background, there's something else going on, which is the bond market. And it's looked at as kind of boring and slow, but there is a lot that goes on, and it actually happens during the day. We had two reprices for the worst today, even though we had an improvement, a reduction in inflation based on the producer price index. How could that happen? Well, let's take a look here. We're going to see how these two things made the market move today, and then our Brent Bruce Daily scenario and where we ended up. So the producer price index is similar to the consumer price index, but the consumer price index is for consumers and the producer price index is for the producers. So the wholesalers, the people who actually build these products or create these products that consumers purchase. Well, they have to buy the products that they need to build the products that consumers buy. And this is where we see how inflation looks for them. Now, overall, the producer price index declined 0.5% in July. So it's very similar to what we saw on CPI. So, of course, that means that inflation is slowing. But look a little bit further into this. It's always good to look further into these reports because it's not hard to look and see things that are going on. Take a look right here. Most of the decline came from energy, which topped 9% at the wholesale level and accounted for 80% of the total decline in goods prices. Okay, so 80% of the improvement to inflation was gasoline. If you take gasoline out, stripping out food and energy, PPI increased 0.2. Okay, it went up 0.2, and that's not even considering food. And we all know that food was up. So if you were to just take out fuel, producer price index could have been at 0.3 or 0.4, which tells you that overall inflation is still hot or growing, even though gasoline prices are making our reports look good. But the markets are interested in the reports. And that's why yesterday we saw a benefit to the mortgage-backed security market from the consumer price index reports. And we're also seeing, we earlier in the day saw an improvement in the mortgage-backed security market based on the producer price index report that it was showing inflation slowing. So let's take a look and see what happened. Here we are. Right now, we are down 30 on the day, even though we had a good inflation report. If you watch this show often, you know that that doesn't make sense. A good inflation report, meaning that inflation is slowing, would actually be liked by the bond market, and the bond market would be green and be showing a positive number here, which we were. Earlier in the day after the PPI report came out, we were up 30 basis points and having a great day. However, again, the excitement of the bond market. It's not just one report. Another report came out, which was the 30-year bond auction. So a 30-year bond auction came out, which is obviously very competitive with the mortgage-backed security market because they're bonds. And the appetite for a 30-year bond at the rates that were being offered was not good. People were just not interested in 30-year bonds at this time. They want a higher rate of interest for that long of a term when it comes to the bond market. So they got a C- rating by a lot of the people that rate these things. And that's not a good sign. When the bond market does poorly, the mortgage-backed security market does not like that. So it reversed course. So if you look at our chart here today, we opened up in this range. We actually shot up 30 basis points, a great day based on the results of the producer price index. We broke through the Fibonacci level and banged up against our friend, the 100-day moving average. Right about that time, as we slowed down and thought about, well, do we want to break through this or not? The 30-year bond auction came out, and it came out ugly. So, no, not right now. So we actually began to fall and lost all of that 30 basis points, and now we're down 30 basis points, a 60 basis point swing today, and we've had multiple reprices to our daily rate sheets because of the volatility. We have not hit these floors of support yet, so we still have some room that we could fall, but fortunately, we have a strong triple floor of support under us. We shouldn't come down into this range unless we get some sort of very negative report that comes out that at this point, I'm just not anticipating. Otherwise, we're going to start to turn around, climb up again, and try to break through these ceilings. And man, I'd love to see us get back up into this range here where I was offering a 4.625. So where are we as far as our interest rates today with this type of volatility? You tell me. If we're down 25 basis points, where should we be on our home loan interest rates? We were at 4.99% yesterday with an $1,800 credit on the Brent Bruce Daily. So if we are down 25 basis points from yesterday, should interest rates be worse or be better? Well, you put that in your head. Let's take a look. Let's run the Brent Bruce Daily scenario and let's see where we are. Down 28 basis points. Okay. And remember, this is a very well qualified conventional home loan. We are at 4.99. Okay. So if we're down, got to refresh this here actually. If we are down 28, 26, 30 basis points, 25, why would the interest rate be the same? Because of the credit. Remember, we were getting an $1,800 credit and now we're getting a $1,576 credit. So basically, for someone to get a 4.99% interest rate, their closing costs just increased $1,300. And you might have to explain it a little bit differently because really they would have gotten a $1,300 larger credit than they are going to get today because there's no cost. It's just the amount of credit that was reduced. So that is what's going on with the response to both the producer price index as well as the 30-year bond auction. Make sure that you get back with me tomorrow and we'll see how this week wraps up and what we're expecting for tomorrow. Thanks for watching. Have a great day.